Hello, Avila Finance students. We are moving along the course. It's hard to believe we're already almost at the halfway point of our course. And go ahead and wrap up everything for your forum discussion this week. In week 3, get your homework questions submitted. I'm going to post this video a little bit earlier this week. But this week is nice, and week 4 is that you'll just have the homework problems, and then we will have an exam that we'll make available Thursday. So just when you take that exam, make sure you give yourself enough time to sit down, that you're uninterrupted, and go through the questions, have your book available, but make sure to get that done before Sunday at midnight because it closes after that time. So, all right, we have 3 chapters this week. Let's first start off with bonds. There's all kinds of different bonds that we have out there. There's government bonds, there's convertible bonds, there's euro bonds. The bond market is really where a lot of companies raise a lot of their capital. It just doesn't get as much attention as the stock market because maybe it's not as sexy, but it's a good source of financing, and companies use debt too to also take advantage of tax deductions, so that the interest they can write off. That's changed for you and I a little bit, especially with interest over the years. It used to be you could write off other types of interest, then it went to just your house. And now with the new tax laws, you're going to find out this year when you do your taxes 2018, most of you are not going to itemize because you just won't have enough in probably interest expense on your house. You'll just kind of take the new standard deduction. So that does change behavior, but companies still get that benefit of tax deduction for the interest, so it lowers their tax liability. So we'll talk about the after-tax cost of debt here in Chapter 9 a little bit. But when a lot of this chapter looks at finding out the value of a bond. This past week actually was a little bit of bump back after a rough week the previous week in the stock market. But, as people get away from stocks, they move into bonds, and that pushes up the prices, but it also pushes down the return. So there's an inverse relationship with bond prices and interest rates. But because the Federal Reserve has been raising interest rates, what's happened to a lot of these bond portfolios is the value has gone down. Like I've looked at some of my Fidelity retirement accounts, and a year ago, like the net asset value was like $11 in some of these funds, and now it's like close to $10. So I've taken some capital losses in that on paper. The hopes is in the long run, but they have to do what's called mark to market, as if you were to sell the bond today. So if you buy a bond for $1,000, you have a 10-year bond. I mean, when it matures, you will get that $1,000 back, but what happens all the time is that interest rates are changing, demand and supply for bonds are changing, so the prices are going to change in the market. And that's what they call the mark to market. And again, the idea that is as if you were to sell it today. So you're going to figure out, you're going to use things like what is the current rate in the market? What is the current required rate of return? And that's going to help determine the present value of the bond. So when you do some of these calculations, as the rate goes up, you're going to see the price you pay for this bond or the price you'd sell it for would decrease. So some of the examples in the textbook, they're going to go annual, but most bonds really pay interest semi-annual. So if you had an 8% coupon, let's say you take $1,000 times 0.08, you'd have $80. Divide that by 2, you get $40 every 6 months. And if it was for 10 years, you'd have 20 periods of getting that $40. So you're also going to calculate yield to maturity in this chapter. That's like if you had bought this bond at $900, it matures in 10 years, you get your $1,000 back. I just want to stress that $1,000 is what the book is going to use as the par value. So think of that as your future value too, that you're going to get some positive $1,000 in the future. And depending on all that information, it's going to tell you, hey, this is your rate of return that you're getting on this bond. So investors buying these bonds, as they go down in price right now because interest rates are rising, are matching that required rate of return in the market. So, and just last, current yield is just it's just by a year. So it's the interest you get in that year divided by whatever price you paid. So if you got $80 in that given year divided by 900, that is your current yield. All right. We get into looking at Chapter 8. We look at stocks, valuation. You're going to look at the idea of preferred stock. Preferred stock is the idea like you get this fixed dividend every quarter. And how can I figure out what the value of preferred stock is? Well, I just take a cash flow, whatever it is in that current year, divided by whatever required rate of return. So they kind of view it as a perpetuity, that this dividend keeps going on forever. So again, if interest rates go up, then the present value of that stock is going to go down too. So, and what you're also going to look in this chapter is looking at what's called the Gordon growth model. It's the idea that, hey, if I have this certain dividend 1 year from now and I can discount it back, but if this dividend is expected to grow over and over again at a certain rate of, say, 5%, how much should I be willing to pay for that today? So I want you to kind of envision that if I did this out into infinity of these cash flows forever, well, they're just doing it back discounted today, but they came up with a simple formula for this. So what you'll see is the value of the stock is equal to the dividends of 1 divided by some required rate of return on this stock divided minus the growth rate. So you'll go through a couple of examples in that in the text. And with required rate of return, I want you to think about this too. On a stock, you're going to receive a dividend, and you could also receive capital gains. So if the company does well, you would expect that the price would go up at the market, and that would give you a return in that way as if you were to sell it in the future at that price. All right, last in Chapter 9, it kind of gives us something to say, hey, what is the required rate of return for a company? When we start getting net present value, internal rate of return, you'll see things like, oh, the required rate of return is 10%. Where did they come up with this number? So what they're going to look at is first kind of go through some concepts. With that debt, some companies are financed with debt. Some are kind of combinations of equity too. If you had this pie and half of it was debt and half of it was equity finance, that say would be weighted 50%, 50%. But if the company was only like 30% debt and 70% equity, it's going to be weighted much more heavily on the equity, and usually require a higher rate of return on equity because it's a higher risk. But with that, what you're going to find out is that you're going to look at the after-tax cost of debt, just as we talked about that there's benefits from tax reduction liabilities. So you're going to take whatever the required rate of return or the yield of maturity is for those investors on that bonds they buy, times 1 minus the corporate tax rate. And you're going to find that's going to lower the required rate of return, which is a good thing because it lowers your hurdle rate on investments. But you're also going to use the cap-in model, which we talked about in previous week, that whole risk-free rate plus beta times the difference between the market return and the risk-free to find the required rate of return on equity. So it's kind of I want you to think of it this way. Now I'm just going to keep it simple. I'm not going to talk about preferred stock, but the text will be in there. But again, if it was half debt, half equity, let's say the after-tax cost of debt was 5%, well, I'd take 0.5 times 5%. And I'd say plus, and if the cap-in said 10%, then I would take half of 10% and make that 5. So I'd have 2.5 and 5. I put it together. It says, hey, the required rate of return on my company stock is 7.5%. So I'd have something as a baseline. And obviously, the higher the beta is for a company, well, that's going to push up that required rate of return as you kind of looked at risk and return this past week. So you're going to look at things like that. So do email me if you have questions. But again, I'll have that test ready and available. They'll be available Thursday. And jump in when you can to get that completed. But otherwise, we'll talk to you online if needed. And have a great week.